Today, we will talk about hammer candlestick patterns. A hammer candlestick is a pattern that appears on a candlestick chart when a security trades significantly lower than its opening price, but rallies to close near the opening price. This creates a hammer-shaped candlestick with a lower shadow at least twice the size of the real body. The pattern suggests that sellers have attempted to push the price lower, but buyers have eventually regained control and returned the price near its opening level. A hammer occurs after the price of a security has been declining, signaling that the market is attempting to determine a bottom. It indicates a potential price reversal to the upside, but this reversal is only confirmed when the candle following the hammer closes above the closing price of the hammer. It's important to note that traders typically utilize price or trend analysis, or technical indicators to further confirm the validity of hammer candlestick patterns. An example of how to use a hammer candlestick involves spotting a hammer pattern on a price chart, then waiting for confirmation on the next candle. During the confirmation candle, traders usually step in to buy, with a stop loss placed below the low of the hammer. The confirmation candle should exhibit strong buying, and the price of the security should begin moving upwards for the reversal to be confirmed. A doji is another type of candlestick with a small real body but has both an upper and a lower shadow, signifying indecision. A hammer, on the other hand, occurs after a price decline and signals a potential upside reversal if followed by confirmation. Additionally, a hammer only has a long lower shadow. There is no assurance that the price will continue to move to the upside following the confirmation candle. Hammers also don't provide a price target, so exits need to be based on other types of candlestick patterns or analysis. Moreover, the distance between the entry point and the stop loss may expose the trader to risk that doesn't justify the potential reward, so careful consideration and risk management are essential. The psychology of a hammer is that it generally emerges in the context of a downtrend, signaling that more bullish investors are taking positions and that a reversal in the downward price movement may be imminent. The long lower shadow suggests an effort to continue the price's downward trajectory, but the higher close represented by the real body indicates that the sellers were ultimately unsuccessful in holding the price at its intraday low, indicating a more bullish outlook. The practical application of a hammer candlestick pattern involves confirming that the pattern corresponds with a hammer signal in a downtrend. Traders then look for subsequent price action to corroborate the expectation of a trend reversal, buying during the formation of the upward confirmation candle. It's also important to place stops to protect the position and set take-profit levels based on other resistance levels such as nearby swing lows. Here are 4 key takeaways. 1. Hammer candlesticks are typically used after a price decline, with a small real body and a long lower shadow. 2. Hammers occur when sellers enter the market during a price decline, but buyers eventually absorb selling pressure and push the market price near the opening price. 3. A confirmation candle closing above the hammer's previous closing price is necessary to indicate a potential price reversal to the upside. 4. Hammers don't provide a price target, so exits need to be based on other types of candlestick patterns or analysis. Hope this would help. Thanks for watching.